Buying SpaceX stock could be a terrible trade. A company with reusable rockets, unmatched in its industry, valued at $2 trillion, and less than a month after its IPO, it's already not worth touching. But here's the part that matters. The tech bull market is not over. Today, I'm going to lay out the logic clearly so you can see exactly what's going on. Why isn't SpaceX worth buying right now? Let's start with the basic facts. SpaceX is currently valued at $2 trillion, but for the full year 2025, it posted a net loss of $4.9 billion. A $2 trillion company not making money. And here's what history tells us. Big, high-profile IPOs are almost always terrible short-term investments. The data backs this up. Historically, large IPOs have delivered an average drawdown of 55% within the first year. Why? Because these deals are almost always priced for perfection. They launch at peak euphoria, with a limited flow creating artificial scarcity just long enough to prop up the price. But the moment the IPO hype cools and those lockup periods expire, anyone who wants to cash out, they cash out. The selling begins and the stock grinds lower. SpaceX is already following this exact script. It spiked briefly after the IPO, hitting a high of $225. Then it broke below its IPO price of $150 and recently has been consolidating around $164. And here's a detail worth thinking about carefully. The exchanges and index providers are rushing to add SpaceX to major benchmarks. That means index funds, passive index funds, become forced buyers after the IPO, creating a second wave of artificial demand. Think about what that means. The money in your retirement account could be passively chasing this thing. So my view is direct. Stay away from these mega IPOs. When OpenAI goes public, same logic. When Anthropic goes public, same logic. These are not the opportunities they appear to be in those first few months. Now, I can already feel the tension building. If the most anticipated IPO in the market isn't worth buying, does that mean this whole bull market is about to roll over? My answer is no. Let me walk you through why. Let's look back at history. During the dot-com bubble, Netscape, Amazon, eBay, these were high-profile IPOs, but they were not the top of that bull market. What actually popped the bubble was speculative mania combined with aggressive Fed rate hikes. In 2019, Saudi Aramco went public at a $1 trillion valuation. Not long after, a bear market did arrive. But the killer was a global pandemic, not the IPO itself. More importantly, the fact that the market can even absorb an IPO the size of SpaceX tells you something crucial. Liquidity is still abundant, and risk appetite is still healthy. The market digesting large IPOs is a sign of strength, not weakness. Here's the point. Mega IPOs can happen in the middle of a bull market. They can happen at the end of one. But the IPO itself does not decide when the cycle ends. What actually kills bull markets has always been one of two things: an external shock or a Federal Reserve that decides to hike rates aggressively into an overvalued market. And I need to make one more critical distinction. The market today looks fundamentally different from the dot-com era. First, valuations. The NASDAQ forward PE ratio today is roughly 23.5 times. That is about 1/4 of where it sat at the peak of the dot-com bubble. The mega-cap tech companies driving this market have profit margins at or near all-time highs, and those margins justify the multiples they are trading at. Second, the driver of this market. This bull run is being driven by earnings growth, not multiple expansion built on hype. Companies like Microsoft, Nvidia, and Google are delivering real revenue, real profits, and real operating leverage. That is a completely different animal from the dot-com era, where companies were being priced on eyeballs and dreams. So here is what I keep coming back to. Don't confuse an overpriced IPO with a market that is about to collapse. They are not the same thing. And that brings me to the question a lot of you have been asking. Does this mean tech stocks are still buyable? My view is this: the core AI earnings story is still intact. The AI core asset story still has room to run, but the stocks in this theme are now at a dividing line. For more detail, you can check my last video. If you see the same picture I do, and you're ready to sit on some cash like Buffett and wait, then you can use this time to learn a steadier approach to putting money to work. Step 1. Use the index, not individual stock picking. For most people, trying to guess whether Nvidia will outperform Microsoft or the other way around is a losing game. The simpler approach is to own the NASDAQ 100, the QQQ. It gives you exposure to the most profitable players in this AI wave in one shot. If the earnings growth from core tech companies is still there, buying the index lets you own that basket of real, earnings-backed companies at the lowest cost. And the index automatically replaces the losers over time. You don't need to track who is falling behind. Step 2. Use dollar cost averaging instead of trying to time the bottom. Macro uncertainty is still extremely high. Nobody can call the exact best entry point. Dollar cost averaging solves this. You invest a fixed amount every month. When prices are high, you buy fewer shares. When prices are low, your money buys more. Over the long run, you get an average cost basis. And more importantly, it forces discipline. When the market drops and you're scared to buy, the plan buys for you. When the market rips higher and you feel the FOMO, you're already in. Step 3, keep cash on hand. If you're always fully invested, when the next real sell-off comes, your only option is to sit and wait for prices to come back to you. But if you have cash ready, that sell-off becomes your opportunity. Never empty the clip. That's not being conservative. That's keeping the right to choose when the market finally gives you better prices. So here are the 3 core ideas from today. Number 1, mega IPOs like SpaceX are almost always bad short-term trades. The pricing is too aggressive and the lockup selling is coming. Number 2, this bull market is not over. What actually ends cycles is a liquidity crunch or an external shock. And right now, market valuations and earnings quality look nothing like the dot-com era. Number 3, the best strategy for most people in this environment is to own the index, dollar cost average in, and always keep some cash in reserve. Don't confuse an overpriced IPO with a market on the verge of collapse. In other words, don't let the pockets of froth in this market blind you to the real earnings-backed opportunities still sitting in front of you. You just need to use the right method to buy them. Drop your thoughts in the comments. I'll see you in the next noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.